Sunny, the FundReveal tool seems to be very useful and fun to use. But does this method really work? Can you show us what returns we should expect? Can you prove it with hard facts?
Of course, Sheila, I will. It really works. We have solid statistical analysis to prove that it does. I use it for my own mutual fund investment decisions. We have tested the method over different time periods using a process called out-of-sample forward testing. This method uses the FundReveal ratings for previous time periods to make investment decisions for the following year, following time periods, or a quarter. There is no curve fitting or technical analysis here. It really works. Remember my friend, the one who works for a beauty products distributor? This table shows the FundReveal 401k Fund Selector report for all the 20 funds of a 401k plan for the cumulative year ending in 2005. The rows are the funds, the first row being that for S&P 500. Look at the two columns named ADR, meaning average daily return, and WCR, which is a short form for worst case return. Based on this report, it was easy to choose funds to invest in the following year, which is 2006. We simply selected funds that had higher ADR and WCR than those for the S&P 500. Is this rocket science or simple? It is that simple. Since higher positive values of ADR and WCR are better, we initially chose only these 6 funds from MLARX through TRRFX as shown by the highlighted yellow color. We then wanted to expand the list to allow diversification into more funds and more sectors. So we added these 7 more funds. Note that the WCRs for these funds are negative, but their ADR and WCR numbers are still higher than those of S&P 500. We repeated this process at the end of each year for 2007 through 2010. This can also be done once a quarter, which is better, but doing it too often is wasteful and actually harmful. Investing in mutual funds is about investing and not trading or getting in and out too frequently, as some folks like to do with stocks. So what does all this do for the bottom line of my friend's nest egg? Did it grow well and yet stay out of dangerously risky investments? The answer is in the following graph. This bar graph shows the total cumulative returns for the 401k account between 2006 through 2010, managed in a disciplined manner as we learned in the earlier session. Compare the total return of 15% using the FundReveal method versus a loss of 4% for S&P 500. Just in case the doubters think that the great total returns as seen in the earlier bar graph could have been due to one lucky year while the returns for other years were bad, take a look at this graph. The numbers in the y-axis are invested dollars. We have normalized the starting amount to $100 for ease of understanding. Notice that the 401k portfolio beat the market in each of the investment years from 2006 through 2010. and it did so even in the market crash of 2008. And this growth in the nest egg was achieved at much lower risk compared to the market. The volatility or risk for this portfolio was much lower than that of S&P 500.
So this concludes our 401k investment education webinar. Hope you've enjoyed it and learned how not to be fooled by stories, old rating systems, old rules of thumb that don't mean a thing. Now it's time for us to take charge of our nest eggs and see them grow without taking high risk. Feel free to contact FundReveal on their toll-free number or send them an email for more questions. Thank you for viewing this webinar.